Welcome to the latest episode of Managing Your Money. I'm here with my colleagues and partners, Matt Bloom, Josh Strauss, and Bill Pekin. And there's just a lot of very interesting and unprecedented historical developments that have been going on in the markets in recent weeks. So we thought we would just take a few minutes to talk about what we think might be going on and where we're going. Just start, and we can revisit this, what all this means later. But in the last few weeks, what we've seen is Treasury bond yields go up, equity prices go down, the dollar go down, and gold go up significantly in all four of those cases. And I think some of the topics that we'll be touching on in this episode are going to help perhaps explain what might be going on and where we're headed from here and how investors should be positioned. So I guess what I want to do is perhaps just start with the tariffs. President Trump announced on April 2nd an unprecedented level of tariffs that he was planning on putting in place across all countries, but especially with those countries that have significant trade deficits with the United States, and even more especially with China. The markets reacted poorly to it. He put a 90-day pause on all of the different countries that were involved, except for China. But it looks to me that tariffs are going up to at least above 20%. What's going on right now? Why is the Trump administration doing what they're doing? Who'd like to start?
I'll start. Well, that's a hard question to answer in a few minutes, but I'll try. And I think people think about tariffs as a unipronged thing, or as they pick out one thing to talk about the tariffs, and really it's a multi-pronged thing. And so I think the tariffs they're for revenue generation in my mind, whether they'll end up at 20% or 10% or somewhere higher or in between. I think they are a method to get fair or reciprocal tariffs is the word they use with other countries. Trump has talked about that the world treats the U.S. unfairly, or there's not non-reciprocal tariffs between the U.S. and other countries. So I think these tariffs are a way to level the playing field with some of our trading partners. And the third is I think it's a tool to leverage production, industrial production, to bring that back to the U.S. So I guess to me, it's a multi-pronged approach to try to again, have more fair trade with our partners to encourage industrial production to come back to the U.S. and to raise revenue. And I think many people think that this is just a gambit, or Trump will cancel all the tariffs or go back to the way it was pre-Liberation Day. And I really don't think so. I think this is part of his plan. I think this is a structural part of his plan. So I think the thinking that this will all go away is, I think, fake news, for lack of a better word, or false thinking. And I think these tariffs are an integral part of Trump 2.0.
That's interesting. So you don't think that this is bluster. You think he's serious about this and he's going to stick to his guns? Because we've seen Trump before put out a very extreme offer, but it really turns out it's just the beginning of a negotiation where he ends up coming way back. What you're saying is this is not a negotiating tactic. This is for real.
It's real. I absolutely. I think it's real. I think how he laid out the tariffs is very interesting. He put the most onerous tariffs on China. We have our trade is most disadvantaged with China in terms of the lack of imports and exports that we get, or most unbalanced, I should say. Probably a better word, with China. Interestingly, he put very low tariffs, about 10% all across for most of Latin America, and then tariffs were across the board. They were different in the rest of the world. But it's interesting that I do think it's part of his policy. I think he is bringing the U.S. back to the Western Hemisphere. I think he's very focused on the U.S. dominating the Western Hemisphere. I think that's why he wants control of the ports on the Panama Canal. I think that's why he covets Greenland. I think that's why he even covets Canada. I think the focus is now trying to dominate and control the Western Hemisphere, which is why he's making the tariffs unusually low in the Western Hemisphere to make it somewhat of a trading bloc, not quite free trade, but a low trade barrier bloc. And the tariffs are interestingly much higher, certainly amongst some Asian economies as well as European economies. So yes, I don't think they're a negotiating tool. I don't think they're a bluff. I don't think we're going back to normal. I think there is no going back under this administration. The tariffs are here to stay. The main question is how high or low will these tariffs go?
Do you think that the stock market has properly discounted this notion that Trump is not bluffing here?
That's a really good question. I would say no, it hasn't totally discounted that. I think the stock market is still thinking that the world is the way that it used to be, that the kind of American empire, for lack of a better word, of the last 15 years, or globalized, mostly free trade world of the last 15 years, dominated by a kind of a global hegemon, American hegemonic Pax Americana, which benefited globalized companies the most, the platform companies being the most advantaged, I think, because they did extremely well in a globalized world where they designed in one place, they manufactured in one place, and they were taxed in another place. They basically optimized all parts of that value chain to lower their taxes, lower their cost of production, and that increased their valuation. I think that era is over. And I think that the market is slowly coming to terms with the era that we are now in a multipolar world. We're now in a world of disadvantaged or tariffed or walled trade. And we are also in a world of persistently higher inflation than we experienced before. And to your point, as you opened up, with higher interest rates. And so when you put all of that together, I think that would be logical to assume that valuations should go lower. I think the last 5 years, my numbers could be a little bit off, but I think the last 5 years in particular, the S&P traded at an average forward PE of something like 20 times. And I think if you go back to the 20 years previous, it traded at a forward PE of something like 14 times. There is no reason why in this environment, the old valuation, the old premium that U.S. assets got should remain. I think all else being equal, there are many headwinds here, many factors that would warrant a much lower valuation and really a return to valuations that we saw from 2000 to 2020.
Yeah. Thanks, Bill. There's been a lot of comparisons about the tariff regime that the Trump administration is putting in place with the last time that tariffs were this high, which was when Smoot-Hawley was enacted. And just going back to what happened during that period of time is Smoot-Hawley is often credited with the beginning of the Great Depression, which was a period of, number one, a very significant recession / economic contraction, and number two, deflation in prices. Is that where we're headed right now? Are we headed for, number one, a significant recession because of these tariffs? And number two, are we headed for lower prices because of these tariffs?
I'll jump in on this a little bit. The short answer is I think we're looking at higher prices and slower growth.
Higher prices, not lower prices.
Higher prices. I think higher prices.
Okay.
The world is far more globalized today than it was years past. And the auto supply chain, the semiconductor supply chain, it's all highly globalized. And it's very hard to bring these things back to the United States, if at all. In some cases, an iPhone, I read somewhere, would be $3,500. And some people will buy them, some people will buy used ones, but there's just no way to easily do it. If the tariffs are anywhere near his initial first take, I think that Billy's right. I think these tariffs are for real. I think the amplitude of it is not as great. I think he is, of course, trying to squeeze our trading partners for whatever they can get. Whatever he can get, I think he's the most. And I think part of this is there's so many second and third derivative impacts of Trump's varied policies with our partners, with our trade partners. The fact that the stock prices have gone down and Treasury yields have gone up, causing the bond market to go down, is contrary to every other downturn over the last, I don't know how many decades, which is in part a reflection of the fact that the Trump administration and the politics of the United States over the last decade or so has made us to be less loyal partners, both from a trade perspective, a geopolitical perspective. Part of the reason why we've been able to have this trade deficit is because we have the reserve currency. And if the rest of the world starts to view the US dollar as less of a reserve currency as it's been historically, that's going to cause dollar weakness, and that's going to cause higher prices. Bringing jobs back to the United States by creating tariffs, it's just not that meaningful. I think, was it Apple who's going to spend $500 billion on US factories over the next few years? I think based on the number of people they're planning to employ, you're talking about $25 million per worker or something. These are going to be highly automated facilities. So it's not necessarily about bringing U.S. jobs back, because the impact's not necessarily going to be that great. But it will translate to higher prices in just about everything. And that's going to push, I believe, is going to push us into recession. And part of this is the fact that as business managers of all sorts, of all kinds, of all sizes, need a stable, legal, regulatory, and trade regime to do business. So if you don't know what the tariffs are going to be, how do you know where to locate a factory? How do you know how many people to hire? And that pause in decision making by business managers is reflected throughout the economy. And so that's gonna end up pushing us into slower growth, if not recession. So overall, I think that we're going to see a period of stagflation, which happens about 10% of the time, most significantly during the 1970s. And investors need to be conscious of it and position their portfolios accordingly.
I want to use one of the subjects that you brought up, Josh, to segue
Yeah,
into
there's
the
a
next
lot
topic.
of that.
I want to, if I can hop on before you segue somewhere else, can I just hop onto that just quickly?
Sure, go ahead.
I think I agree a lot with what Josh said. I think it's unclear to me whether tariffs will be deflationary or inflationary. To Josh's point, the argument behind deflationary is that, right, it'll slow the economy down. All the tariffs are causing chaos and uncertainty. There's hesitation to invest, and that is net a deflationary or likely a deflationary outcome. And the argument, and tariffs are a tax, and so economic activity should decrease, and so that's all deflationary. And the argument that it's inflationary is that prices are going to go up. It is a tax, and so prices should go higher, and maybe it's stagflationary. But some people believe that tariffs will lead to this inflationary outcome because, as Josh talked about, prices are going to rise. I tend to believe with Friedman that inflation is a monetary phenomenon, and ultimately, I believe that maybe the inflation will eventually come from increased liquidity as the government, maybe you're going to get to this, Adam, but as the government eventually has to resort to some type of lowering interest rates or QE 1, 2, 3 again, or yield curve control, ultimately, I think liquidity will open up again to balm the effects of tariffs. But the last point I wanted to talk about, starting with your analogy of Smoot-Hawley, and my historical knowledge is not perfect, but my understanding of what happened in the 1930s, I think if you use the 30s as an imperfect analog to today, the U.S. in the 1930s, 20s, and 30s was the China of today. The U.S. was the industrial powerhouse, was growing a lot faster, was a cheaper industrial producer, and maybe the U.K. was the U.S. of today. The U.K. was coming out of World War I, had this empire, was massively in debt, was relatively deindustrialized. And in that my understanding was when that Great Depression happened, maybe as in part a result of the Smoot-Hawley tariffs, maybe there's, I'm sure, other factors, but deflation hit the great industrial power of the U.S., i.e. the U.S. had excess. As world trade ground to a halt, in part because of these tariffs, the U.S. as the industrial producer, the kind of swing industrial producer of the world, was met with deflation because they had excess capacity. And the risk today, really, I think, is that China, being in the place of what the U.S. was like in 1930, will likely face deflation. That's been actually going on with China now for the last several years. And my understanding was that the U.K., as the main importer country, was met with inflation as the cost of goods increased to them. So today, the analog would be that the U.S. was the Great Britain of 1930. And so if history follows, we are likely the ones to get into an inflationary spiral, and China is likely the ones to get into a deflationary spiral.
That's a helpful analysis. I want to turn to the subject of capital flight and a question for Matt. In recent weeks, we've been reading about rumors that the reason that the dollar is going down and that Treasury bond yields are going up, which means that effectively either nobody's buying bonds or they may even be selling Treasury bonds. There's rumors that China is selling their treasuries. There's been rumors that Japan is selling their treasuries. I think there's some data that's showing that foreign capital is leaving the United States, perhaps out of bonds, perhaps out of stocks, perhaps both. What's going on there, Matt? Why is capital leaving the United States? And is that a trend that is just a temporary blip or something that we should expect is going to continue?
I think there's probably more than one reason for it. Josh touched on the idea of the U.S. simply being a less trustworthy partner. If you can't trust that the policies and the trade environment are going to be stable and predictable, then the U.S. is a less attractive partner, both in terms of trade and politically and militarily and all those things, right? So if the U.S. is simply a place that you can't necessarily count on, then you don't want to have as much exposure to it. And some of it also, I think, is practical. If the U.S. is putting up all of these trade barriers with all these various countries around the world, then there's simply going to be less trade between the United States and all these other partners. And so you have less need to hold on to dollars and dollar-denominated assets, whether it's treasuries or U.S. stocks or what. I think there's just less need to have dollar-denominated assets. And I think it certainly appears that this capital flight is really occurring. Over the last, 10 years, you had so much capital flowing into U.S. assets because you had all these dollars outside the United States, and the U.S. was such an important trading partner, even not necessarily the U.S. as a trading partner, but the U.S. dollar as a trading currency. You had so much need for that there was a good reason for all these countries to hold on to dollar-denominated assets, and now it appears that is turning. And look no further than the performance of all these other foreign markets this year. Compare the performance of the U.S. indices versus a lot of the foreign markets, and it appears to be pretty clear that capital is simply flowing to its home markets. So yeah, I think there's a couple reasons for it, and to me it seems to be something that is probably going to go on for a period of time. Certainly, I don't know how long. I don't know if the Trump administration is going to hold the line. Billy was saying earlier that he thinks that these tariffs are a real policy and not just a negotiating tactic. And if he's right, then I think that this probably has a fairly long runway. Because that's a structural change. If you're not going to use the dollar as extensively in trade, then there's simply not going to be the same structural demand for U.S. assets. I think it could go for a while.
But you're right, and this is a structural change. It's not temporary. What does that mean in terms of the dollar and treasury bonds? Who's going to be buying our treasury bonds, and what are the investment implications?
Well, I mean, that might be a question for Jay Powell. At a certain point, somebody does have to buy them because they're certainly going to be continuing to issue them. I do think that there's going to be less demand from international buyers for sure. If there's less need to recycle those dollars into U.S. denominated assets, then our foreign partners are not going to have as much need for them. Maybe that's where the Fed steps in. I don't know. It's actually a little bit of a scary thought.
I just want to jump back. I think those are interesting questions. I agree with everything that Matt said. I 100% agree with what he said. And I think, Adam, I want to go back to what you said when we started this call, which was, I don't think people really understand how unusual this period has been, the last 2 weeks has been, in that everyone's so focused on equities. But the thing that is unusual is that, as you said, equities were down, bond yields were up, which means bond prices were down, and the dollar was also down. That trifecta has rarely happened, certainly in the last 5 years and really in the last 25 years, maybe a blip during COVID, but I don't even think all those three happened during COVID. Certainly you had the bond market dysfunction and equities dysfunction, but I thought the dollar always went up during COVID, but I could be wrong. But to me, that is something completely new that usually only happen in emerging marketing crisis. And either we are in emerging marketing crisis, and in some ways we are, or to get to your question, Adam, it is an example of capital flight, right? If the dollar is down and if bond yields are up, that means capital is leaving. Capital is leaving U.S. Treasuries and capital is leaving the U.S. dollar. And that is a fundamentally different era. If we are in this era, that means we are in a completely different era, a completely different paradigm than I think most investors have certainly experienced the last 15 years, and really since most American investors have experienced it since Bretton Woods, or maybe even since 1971. Two, I would say, I think this process, this rotation away from U.S. assets is a long-term trend. It is not something that is one and done, just like the tariffs. It's not something that it's all tied up and done. We've scared away all this capital. I think this is a long-term rotation out of overvalued U.S. assets that have with the U.S. market becoming less trustworthy, as Matt was saying, with the president acting like more of a dictator at times, with our laws under threat, with threat of firing Jay Powell, which would be unprecedented, with the administration saying they may tax certain foreign holders of U.S. capital, all of a sudden, U.S. capital looks a lot less, or U.S. assets look a lot less attractive than they were before. And so I think if you're the marginal foreign buyer and you're seeing this very, I don't know, aggressive or anti-foreign administration, I think that you're thinking twice about your U.S. holdings. Today, U.S. equity market cap is 65% of world market cap. In 0809, it was only 40%. The U.S. is 24% of GDP and 4% of world population. There is no reason that U.S. assets need to dominate the market caps in the way that it does. And I'll just say one last thing and then I'll stop. I think in this previous world that we lived in, which was ordinarily U.S. spends a lot of money, the economy grows fast, which means earnings grow, which means stock prices grow, and which means that the dollar is also bid, was a kind of a perfect cycle. And so if you were a foreign investor, it was almost a twofer because you put your assets in the US. The US was exceptional only because we spent an exceptional amount of money, but you had the dollar go up, which means you won on your foreign currency, and more or less you had the S&P go up, so your assets also appreciated. But now, if we are in an environment where the administration wants the dollar down, and the dollar has been declining, and it looks like the administration is relatively unconcerned about U.S. equity prices, so now you have U.S. currency down, dollar down, and you have both stocks and bonds down. Now you're losing twice as a foreign investor. And I think the average foreign pension investor will look at what's going on in the U.S. and say, I'm not making money anymore. In fact, I'm losing a lot of money, and it's time to leave and go elsewhere.
Okay.
Or even just at least doing some profit taking. I mean, if in the last 15 years, if you're a Norwegian investor, you're up 1,000% on the S&P, 500% in terms of investment return, and then the dollar's doubled relative to the Norwegian kroner. You say, okay, time to move on. I'm with you,
It's time to move on. Yeah.
Yeah.
Let's move to the topic of gold. In the midst of all of these seemingly almost not unprecedented, but in the midst of market events, which we haven't seen in decades, we're seeing a market event in gold, which we haven't seen in decades. Gold is up, I think, 50% year over year. It's off to the best start in 2025 than it has since the decade between 1970 and 1980. What is the gold price telling us? What is going on and where are we headed from here?
Certainly, part of it is simply the weakness of the dollar. The dollar is at a 3-year low relative to other currencies, and gold moves opposite the dollar. So that's part of it. But I don't think that tells the whole story.
A small part, because I think the DXY is down like 7% this year, and gold is up, I think, almost 30, if not more than 30% by now.
It's over 30 now. Yeah, no, it's not the whole story.
Yeah,
I think that there may be an element of, hey, look, if the US dollar is going to be less of a trading currency, then maybe gold is used to settle trade, right? Maybe there's an anticipation of more need for gold in trade, maybe, or simply as a reserve that is no longer the dollar, right? If you can't rely on the dollar, if you can't rely on the US, again, to be a stable place and for the dollar to be a stable currency, then maybe you rely more on gold. I think this is a continuation of something that started in 2022 when the US froze Russian assets, dollar assets. The rest of the world took notice of that and said, hey, if we can't rely on our dollar denominated assets, then maybe we don't want to own as many dollars. And now that you see a lot more uncertainty in the stability of the US and the stability of the currency, I think it's just I don't know, magnifying that same thing.
If that's an explanation, wouldn't you have expected gold to go up 30% in 2022 rather than going up 30% in 2025?
It certainly did go up a lot.
I think it's flat that year.
Is that right? Maybe.
Yeah.
Okay.
I think it's about flat.
Okay, that's fair. I think that there was still the idea that we were in the old paradigm, right? I still think that the world believed that the US was a place that could be relied upon and that the dollar was a currency that could be relied upon. And I'm not suggesting that the dollar is going to lose all of its reserve status. The dollar makes up, I think, historically has been like 64% or something of international reserves. And it's not going to zero. People talking about that stuff online, oh, the dollar's not going to be a reserve currency. It's still going to be a reserve, but I think it's going to be less of one. And so I guess what I'm saying is I think 2022 got people's attention. And what's happening now is simply saying, okay, this is for real, right? The dollar really is a less reliable currency. The US is a less reliable place. What happened in 22 was the shot over the bow. And now we've got an administration that can't be predicted, can't be counted upon. And so I think the rest of the world is saying, hey, maybe gold is a better place to have some of our reserves rather than having so much in the dollar. I don't know. That's one guess. But even then, even this move is so significant that maybe it's just a hedge against craziness. I don't know.
Billy, do you want to weigh in here?
Yeah, once again, I agree with what Matt said. I think if the U.S. Treasury bonds have failed to act as an anti-fragile asset in the portfolio, in other words, U.S. Treasury bonds, certainly 10-year bonds, have underperformed, which is why we've kept our durations very short. But U.S. 10-year bonds have failed to perform as a kind of a hedge against equity underperformance, really more or less since COVID. That correlation started to break down during COVID. There were times when it did, but by and large, since COVID, if you bought 10-year Treasuries at the start of COVID, you're way underwater today. So U.S. Treasuries before were the bedrock of the whole financial system. It was the anti-fragile asset of the financial system. That, going back to what we were saying before, is no longer the case. If the dollar is not anti-fragile, as the dollar goes down, if U.S. Treasuries aren't anti-fragile, as they've shown to be not anti-fragile in the last 5 years, then I think gold is really one of the few hedges out there. So I think part of it is global investors realizing that there isn't an alternative anymore. There isn't. It's Tina for gold. There is no alternative. There isn't any other acting anti-fragile asset out there. And so far right now, at least for the time being, it's been gold. I think too is, to your point, central banks have been the major buyers of gold in this recent cycle. Central bank buying has been ferocious and relentless. Every day, it seems when you look at the Chinese open at night, the price of gold spikes up every single day almost for the last 20 or 30 days. There's just massive Asian buying. China, India, there's a lot of buying going on in the Asian markets, and central banks globally have been big buyers of gold. And interestingly, and conversely, the average Western investor has been out to lunch on gold. Recently, you saw some fund flows, but the GLD ETF shares outstanding continue to trend lower. The gold miners, the GDX share outstanding continues to trend lower. So what's interesting is that everybody got this memo that gold is the anti-fragile asset, except the Western investor, who still hasn't cottoned on to gold yet for some reason. I think that investor will over time, but I've been surprised.
One thing to jump on your commentary, Billy, is when you're looking at reserve currencies and you suddenly have, let's take big dollars, let's say $5 billion that you need to put somewhere. You can put it in treasuries historically, not move the market and be like, oh, okay, I'm fine. The issue with any other, and maybe you could do US mortgages too, Fannies and Freddies, but other than that, you're going to move the market. You're going to buy $5 billion worth of gold, you're going to move the market, whether it's futures, whether it's swaps, whether it's physical, you're going to move the market. And that's what I think we're seeing. Right, we're seeing on the margin, the dollar is still going to be a reserve currency. It's gonna. There really isn't an alternative. But the world is searching for other alternatives, and so there's chinks in the armor. And as these chinks in the armor happen, you're seeing gold rally, because if you want to buy gold, you're going to move the market if you're buying a lot. And so we're just at the beginning stages of a dramatic shift in the price of gold, in the value of the dollar, and you need to be positioned accordingly to address that.
Yeah, and to your point, I think that the statement that the dollar will be the reserve currency that both of you made is a debatable statement. I don't know if that's so true anymore, and it may be true in part, it may be true for parts of the world, but it's increasingly looking like the dollar is losing its reserve status, which would dramatically change life for us in ways that we can't imagine. But it's only in the modern era, I think, since Bretton Woods, that most central bank reserves have been chock full of fiat currencies, whether it was the dollar or pound sterling. It used to be that central banks really had gold as their reserves. It looks like we are getting back to, as the dollar loses sway as reserve currency, we are getting back to holding more and more gold as part of the central bank reserves. But to your point, Josh, as Matt brought up, since the Biden administration sanctioned the Russian foreign reserve assets as a result of the Ukraine invasion and put every foe or neutral country on notice that the US can do the same to them at any moment, the dollar has not been as desirable as it was before. And countries since really then some of them have broke from the dollar as the exclusive payment for commodities and energy. We have today, for the first time since 1971, countries are buying their oil in non-dollars, which never happened before. We don't understand that as Americans. It's never happened before. So as countries continue to trade in commodities or trade with each other, not in a dollar or not in a SWIFT system to get around either U.S. control, what have you, or fear of confiscation, the dollar will be used less and less at the margin. Who needs the dollar today if you can transact in your own currencies?
Yeah, I think what Josh brought up there was really interesting. My personal view is that the dollar is not going to lose in its entire reserve status. It's simply going to lose. The international reserves are being rebalanced, and that rebalancing is away from the dollar as such a dominant reserve currency. Again, because these central banks have a whole bunch of different currencies. The dollar is a certain percentage, looking across the world, the euro, the yen, the Swiss franc, all that, gold. And they're simply rebalancing, but on the margins away from the dollar and into these other assets, including gold. And because none of these markets are as large as the US Treasury market, any rebalancing has a significant effect on that market. And that I think what Josh was saying, when you're rebalancing away from the dollar and into gold, even a small rebalancing away has a huge impact on the gold market. Because the gold market, even though it's large, is nowhere near the size of the Treasury market. And so just these small marginal changes are having a major effect on gold. But I think that the trend is very much away from the dollar. I think that we're going to see that percentage of reserves made up by the dollar, we're going to see it continue to decline in favor of a lot of other currencies and especially gold.
So far, we've been talking about several structural changes that are related, but are all going on right now. A rebalancing of trade flows to balance trade, a restructuring of capital flows to balance capital flows, the replacement, or at least partial replacement, of U.S. Treasuries with gold as a potential foreign reserve asset among foreign central banks. One of the structural features of the economy over the last generation or two has been persistent federal deficits. We're all aware of this initiative by the Trump administration, this Department of Government Efficiency, to try and cut costs out. That's one aspect of it, but there's like a larger question. In the midst of all these other structural changes, what happens with this federal deficit that exists here? Should we be expecting a structural change here? And if so, what are the investment implications?
So when you're looking at spending, right, what's happening with Doge?
Josh, can you lean forward, please?
Sorry. What's happening with Doge and Elon Musk's efforts? They're peanuts. 75% of our spending is in just a couple of categories, which is entitlements, so that's Social Security, Medicare, Medicaid, the military, and interest expenses. And Doge is tackling the other 25%, which is why they originally targeted $2 trillion in savings. Didn't find that. Then they chose it to $1 trillion. And right now they're at 150 billion, if that number is actually accurate, which some say are suspect. I don't really know. Okay, fine. If the federal government is able to really cut costs significantly, then that has a positive impact on the dollar. But I don't see how they're able to do it, because at the end of the day, if entitlements are such a huge percentage of it, as long as the political system is the way it is as it is, and politicians constantly have to be able to look out for the next election, they're going to kick the can down the road. And I just don't see a significant step change in spending happening. Doge is not this is not the first time that a new president has come in and says, I'm all about efficiency and cutting government fat. It's a little louder. Have they been more effective? I have no idea. I haven't done an analysis of that, but I just don't see it having a significant impact.
I think you make a good I think you make a good point. We've seen the Trump administration say several times they're not going to do anything at all whatsoever to touch Social Security, to touch Medicare, to touch Medicaid. Like these entitlement programs, at least during the course of the Trump administration, seem like we're not going to see any cuts in these areas. Well, important to a lot of people are now currently represent a huge percentage of the federal budget. So that to me like begs the question: are we going to see structural changes in the deficit, or are we going to just see more of the same?
I don't see how you do it. It's political suicide, right? There's a reason that it's gotten to the point that it's at, because nobody wants to touch it politically, because it's a guaranteed loss of your job. You start cutting in these areas, and the very next election you're done. And every one of these politicians knows it. And so they can do stuff on the margins, stuff that makes some headlines, but there's no way to make major changes. And then military defense spending, they won't touch it. And again, maybe on the margins, but those are things that are they're so locked in that there's no way. And then if you did dramatically reduce deficit spending, you crash the economy. The last couple of years, the only reason the economy hasn't been into recession is because of the deficit spending. And so there's too many negative impacts.
It strikes me that there is one area of deficit spending that they could potentially have a significant impact, and by impacting that could actually ignite the economy rather than slow the economy. And that is service costs on the debt. A huge amount of the expansion of the deficit in recent years has been interest rates going up. Long-term interest rates have gone up from where they were in 2020. Short-term interest rates have gone up. And so as the government has had this huge bloated amount of government debt outstanding and interest rates have gone up, every new bond that matures gets reissued at a much higher interest rate cost. And the interest rate costs of the US government have been ballooning. They're now larger than the Defense Department. I think they're on par of Social Security right now. If the Fed or the Treasury or some coordinated effort were to cap interest rates at, say, 2%, even if inflation is well higher than 2%, that would significantly help the federal deficit that exists today. And it would probably reignite the economy because suddenly borrowing costs are a lot lower than they were before.
I think that's the only way out. I mentioned that QE or yield curve control. I think that is basically what you're saying is yield curve control. That is the only way forward. They have to keep real rates negative. They have to keep rates low and let inflation run hot so we can inflate away this debt. There is no other way out of this problem. We're running deficits at 7% of GDP, which is the highest level in peacetime in an economic expansion in U.S. history. I think we're running deficits as a percent of GDP, which are on par with World War II. We are spending like a drunken sailor. I've used, and the administration has used, the analogy that we are like an alcoholic. We are spending, and we're now going into a period of detox as the administration tries to do Doge. To Josh's point, we'll see how successful it will be. But I think we are now in a period of relative austerity relative to the rest of the world, which is the U.S. cannot continue to run deficits at 7% of GDP in a non-recessionary, non-hot war period. It's just not sustainable because it's gotten us to the point where Adam said, where now interest expense is greater than military expense. And Ferguson's law is every time a power's interest expense gets greater than their military expense, it's no longer a great power. We are up against that now. I think that we crossed that threshold in 2022. My understanding is Social Security at 1.3 or 4 trillion is still the number one single line item expense, but interest at 1.1 trillion annualized is now the second largest line item expense. I think defense is after that. We are creating at current spending rates 1 trillion of new debt every 100 days. Every 100 days, the debt increases by $1 trillion. This debt will never be repaid. it's impossible to be repaid. It will be rolled only, but it can't be repaid. And I think at the margin, the spending has to come down, whether it's through Doge or through other means, it has to come down as a percent of GDP. And maybe the easiest way to do that, as you suggest, Adam, maybe it will be that will get us into yield curve control. Maybe they will change the SLR rules to force banks to buy treasuries. Maybe they'll change retirement rules to force investors to buy treasuries. I don't know. It's unclear. But at the end of the day, the government needs to be financed. It needs to be financed at affordable rates. I think the average weighted cost of the debt today is only 3.8%, something like that. But even at 3.8%, with 80% of our issuance in Treasury bills of 1 or 2 years or less, which is the inverse of what it used to be historically, our interest costs are still the second largest line item and still well over $1 trillion. So to your point, Adam, mathematically, I think they need to get that weighted average interest expense lower than 3.8%. Maybe the right number is 2, we'll see. But yeah, that's why we're in the pickle that we're in today. And
that
going
probably
back
also
to, I'm sorry, and going back to just tying this all together in a neat little bow, we talked about foreigners. Who is going to finance us? Right? We forget that we're a deficit nation. We are financed by foreigners, and we look to be a less and less attractive bet. And yet we're running deficits as much as we ever have before. Who is going to finance us at rates that we can afford?
if there is yield curve control and rates go down to 2% or whatever, who's going to be buying that debt?
The Fed. So it's the only way.
And
There's nobody else who would do it.
Bill, to go back to something you said earlier, you quoted Friedman and about inflation being always and everywhere a monetary phenomenon. That then there's a cost to this potential yield curve control policy, and that's the U.S. dollar. The U.S. dollar is the escape valve, and
that's right.
And yes, the U.S. needs to bring down its debt to GDP. It has to do that. It has to keep its borrowing costs low, but the expense is it'll be at the dollar's expense, and the dollar will have to weaken to do that. And it's inflationary. Investors need to be positioned for that.
Which goes back to what we were saying before. If the dollar has to weaken, the dollar isn't an anti-fragile asset, right? If the dollar keeps going down, then treasuries and the dollar aren't anti-fragile assets, which goes back to why gold has more appeal, right? It all fits together. But I think I think the release valve ultimately is the dollar, and is ultimately, to what Adam said, is higher inflation. The cost of yield curve control is to let inflation run hot, which will destroy the dollar, and it's going to be a painful period. Longer term, I think it's an important adjustment that we have to go through. We cannot keep spending like this. So we're going to have to go through this period. And I think we will get through it, but it's going to be an adjustment.
Okay, so let's try and wrap things up here. We're talking about a bunch of structural changes that don't seem temporary in nature. We really are moving into a different era. And Bill, you just said this is something that we just have to go through and we have to get on the other side. If you are an investor and you're trying to figure out, how am I going to get through this period of transition? How am I going to get on the other side? What are the investments that I should be seeking to own? And what are the investments that I should be seeking to avoid?
I'll jump in with a few things, and then Josh, Bill, you can come in with some more. But obviously, we've made the case for gold. Gold has already shown that it's an asset that has the potential to protect investors from some of these big structural moves. But along with gold, other hard assets, other commodities, and the producers of those commodities, I think, should at least help to protect investors, assuming that this does have some analog to the 70s, right? Those were assets that performed well in the 70s. So hard assets and commodities should, I think, do well. Non-US dollar denominated assets, foreign stocks should, I think, do reasonably well if capital continues to flow out of the United States back to its home markets. You should see those markets do well. Real estate, again, going back to that hard asset idea, I think all those things should at least help to protect investors from some of the volatility and declines in US assets.
Yeah, I don't have a lot more to add to what Matt said. I think, as I said before, I think the only true anti-fragile asset left for Western investors is gold. I think we've shown that treasuries and the dollar is now no longer, those are sales. They're no longer anti-fragile assets. And so I think gold needs to be part of the portfolio in a much larger way than investors have been used to, and will take the place more and more of bonds in this environment. In the last really stagflationary period that we had in the 1970s, gold way outperformed bonds. It really outperformed equities as well. So I think gold should play it in been doing that this year. Certainly it even did that last year as well. And gold is actually now outperforming the S&P on a 5, 10, 25, and 55-year basis, or 54-year basis. Gold's outperformed the S&P going back to 1971 when it was allowed to freely trade.
It has nothing to do with your birthday, does it?
No, it doesn't. Although thank you for reminding me of my age. That's why I can do that math so easily. And then two, I think, as Matt said, I think commodities. Listen, I think that commodities today are historic relative to financial assets are as cheap as they've ever been in the last 100 years. And commodities tend to do well in inflationary environments. So you're starting with very cheap valuations and in an asset class that does well in, historically at least, inflationary or stagflationary periods. And as I've been saying a lot around the office, trade wars lead to capital wars, which also lead to commodity wars. So ultimately, I think you'll see gates up like we saw in 2022 on certain commodities, which will make the price dear. And then to Matt's point, I think foreign assets on a relative basis, we are in austerity here, or relative austerity, and I think there's much more stimulus as other countries are taking their capital back home and are reindustrializing and building up their militaries because the U.S. is withdrawing. I think you'll see, and because they've been spending far less and their budget isn't as in a precarious situation as we are, I think you'll see on a relative basis foreign countries doing much more fiscal spending than we are. And I think they'll have faster growing economies than we will for this adjustment period. So I think foreign stocks, I think it'll be the inverse of what we saw the last 15 years where US stocks were the only place to be. I think we'll now see foreign stocks outperforming US stocks on a relative basis. And my last final thing is keep bond duration short. Bonds always do poorly. Long-term bonds do poorly in an inflationary environment. So I would keep bond duration short. And my last comment is to keep in mind that we are not going back. It's just like when you have that toothpaste that when you take that toothpaste and you push out too much, once that toothpaste is out of the tube, you can't get it back in. We are in a new era, and you need to forget the era of the last 15 years. We are not going back to that era anymore, and embrace this new era that we're in, and investors that can adapt to this new era can find a way to thrive.
My turn. So I'm not going to add. I agree with a lot of what those guys said. I think the toothpaste analogy is super important because it is different this time. It is different. We've had a 40, 50-year bull market in bond prices, and those days are done. And it started in 22 when you had the traditional 60-40 split between stocks and bonds for investors being a good portfolio diversifier, but both stocks and bonds fell in 22, and that's happening this right now as well. To Billy's point, I think that short-dated bonds, whether it's Treasury, high-grade bonds, because credit spreads still remain tight, whether it be Treasuries, mortgages, or high-grade corporates, 1, 2, 3 years, you're going to get paid what you deserve. And inflation may rise, and you'll have that capital available to deploy at higher yields or in other assets as need be. But many years ago, Adam brought up the point that gold is not like buying a stock where you have one arrow in the quiver. It's its own quiver. It's its own asset class. It's a super long duration, floating rate, zero coupon bond, right? And if you want to get protection from inflation and protection from financial dislocation, you want to get protection from US dollar weakness, that's where you go, right? And you want to avoid the Mag 7. These are great businesses at very high valuations, but foreigners have 30% of capital that's been flowing the last couple of years has been flowing into the Mag 7 from abroad. That's going away. So valuations are coming down, and the amount of spending they're going to be doing is going to go down. And you want to find other places to put capital than just passive floats that it works historically.
Okay. Josh, we're going to let you have the last word. Thanks, Bill, Josh, and Matt for participating here. And for all of you who watch this, I think this is a pretty important discussion that we have. We really are entering a new era. The rules are changing, and investors adjusting to those new rules. And I think there's going to be a lot of money lost and a lot of money made in the coming years as a result of some of the structural changes that we talked about today. So I think these are really important topics. And my guess is we will be revisiting these topics in an upcoming episode. So thanks very much. And we'll be back probably in a few weeks.